Most investors don't worry about market crashes until they're already down 20%. By then, they make the worst financial decision of their lives. If you're worried about a market crash, I want you to know something. That worry you're feeling, it's completely rational. Your brain is doing exactly what it evolved to do. It's trying to protect you from loss, and that's a good thing. By the end of this video, you're going to understand what a market crash actually looks like based on all the historical data. You'll understand why our natural instincts work against us in this way. And most importantly, you'll know exactly how to position yourself so that when the next crash comes, and it will, you'll be ready. Let's start with why this feels so scary in the first place. Behavioral finance research shows us something interesting. We feel those losses about twice as intensely as we feel an equivalent gain. So when your portfolio drops 20% in a matter of days, it doesn't just feel bad, it feels catastrophic. And if you're approaching retirement or you're already retired, that fear can get even more intense because you don't have 30 years to recover anymore. This is your biology working against your financial success. And this shows up in the data. Research consistently shows that the average investor significantly underperforms the overall market. And that's not because they pick bad stocks. It's because of when they buy and when they sell. Over 30 years, the 30-year period ending in 2021, the average equity investor earned about 7% annual. The S&P 500, the top 500 stocks in the US, returned closer to 10.6%. That gap, it's almost entirely behavioral. And it's not improving. In 2024 alone, the average investor trailed the market by almost 8.5 points. Here's the pattern. Investors chase returns. They buy after the market's already gone up, and they panic sell after the market's already gone down. The average investor is only going to hold their investments for about 4 years, and that's just too short for a complete market cycle. This behavior gap, it matters even more when you're living off your portfolio instead of adding to it during your working years. And so that is what our brain is doing to us. Now, let's look at what actually happens during the market crashes. Since 1928, the S&P 500 has experienced 27 bear markets. That's an average of one every 3.5 years. This isn't some rare circumstance. It's routine, and we can plan for it. Most bear markets last somewhere between 9 and 13 months. The shortest was during COVID. It was only 2 months from the peak to the trough. The longest was the Great Depression and the tech bubble in the early 2000s. Both of those bear markets, they lasted multiple years. But your average bear market, it's going to fall in that under a year range. So let's talk about how far they fall. When a bear market happens during a recession, the average decline is 43%. That's significant. When there's no recession, it's about 27%, and most fall somewhere in that 20 to 35% range. The really catastrophic ones, the ones where we lost half the value of the market, like 2000 to 2002 or 2007 to 2009, those are rare, but they are the most memorable, and they shape how everybody thinks about risk in investing. The recovery record, that's what matters most, right? The United States has recovered from every single bear market in history. Every one. We can't guarantee the future, but 100% track record is pretty good. Vanguard's research shows us that after market corrections, so a decline of 10% or more, average forward returns at 1 year, 3 year, and 5 years out have all been positive. Every single rolling 20-year period in the S&P 500's history has had positive returns. Every single one. Now, 42% of the market's strongest days in the last 20 years occurred during these bear markets. So if you're sitting in cash and waiting for things to calm down in the news, you're almost certainly going to miss out on the days that matter most to investors. So if the data shows that staying invested works, why don't people do it? Well, Dalbar quantified that research for us. Over 30 years, the average equity investor underperforms the S&P 500 by nearly 1% per year. And that behavior gap, it compounds year over year into hundreds of thousands of dollars over a lifetime. Vanguard found that investors who panic and move to cash for 1 year have an 87% chance of underperforming compared to those who just stayed the course. Now, the best days and the worst days in the market tend to cluster together. Missing just a handful of those best days can absolutely devastate long-term returns. You can't time it, and nobody can. The pattern, it's always the same. People sell when they're scared, and they wait too long to come back. They miss out on that recovery. But something changes when you start to think about retirement. The strategy that worked perfectly while you were building wealth, staying aggressively invested in stocks and riding out every storm because you had decades ahead of you, that strategy can be dangerous when you're getting ready to retire or if you're already living off of your portfolio. So let's talk about how to prepare. Now, you can't control the market. I know I certainly can't, but you can control your response. If you're approaching retirement or if you're already in it, you need a different playbook than the one you used during your working years. First off, it might be time to rethink your asset allocation. That's just how your investments are split between things like stocks and bonds. That primarily stock portfolio that served you well for 30 years as you were working and contributing to the accounts, it might not be the right tool for the job anymore. Morningstar's 2026 research found something surprising. The highest safe withdrawal rates actually came from portfolios holding between 30 and 50% in stocks. Not 100%, not totally growth oriented. Bill Bengen, the creator of the 4% rule, he puts that sweet spot somewhere between 40 and 60% stocks. Now, this isn't about being conservative. It's about being strategic. More stocks doesn't always mean more success in retirement. Now, second, consider building up a cash reserve in your accounts. 2 to 3 years of portfolio withdrawals sitting in cash or short-term bonds. This isn't a market timing strategy. It's emotional insurance. When the crash comes, and it's coming, you can take your retirement paycheck right from that cash instead of having to sell your stocks at the bottom of the market. It lets you stay invested when it matters the most. Now, during your working years, when you're still contributing to the accounts, you can just wait out the crash. In retirement, when you're drawing it down, you still have to take those withdrawals to fund your spending. A cash buffer is one solution to this problem. Now, third, it's knowing your numbers. Morningstar's research for 2026 shows a safe starting withdrawal rate for somebody entering retirement at 3.9% of their account balance, and this for a 30-year retirement. Now, other industry experts will put this number a little bit higher, but if you can be flexible, if you can reduce your spending by 5 to 10% during bear markets, your portfolio success, it can go way up. Now, fourth is identifying your fixed expenses versus your flexible expenses. And this is before the crash. If you make a list today, if you understand what's truly fixed, what's truly necessary for your life versus what is flexible, what could I cut back on when the market crashes? If you know this before the crash, it eliminates the panic and having to make these decisions when everything's coming down. Now, most retirees can identify 10 to 20% of spending that's discretionary. Having flexibility means you can keep your stock allocation invested even when the market is tanking. Now, fifth is have a plan for rebalancing your accounts. Decide now. When the market crashes, are you going to rebalance? Will you add to your positions? Are you going to hold? Write it down. Make a policy, not during the crash, before it. Having a rebalancing plan can allow you to take advantage of opportunities when the market drops. These could be things like tax loss harvesting or Roth conversions. Now, sixth, it's just expected. Based on historical averages, you're going to experience roughly 14 bear markets over a 50-year time horizon. Expecting them makes them less shocking. They're not aberrations, they're features of equity investing. All these steps, I know I say them, they sound straightforward, and in principle, they are. But getting each one calibrated to your specific income, your timeline, your tax situation, that's where the math starts to get personal. It's exactly the kind of work that a financial planner can help you do. You can't have permanent returns in the market without the temporary declines. They're unfortunately an inseparable package. Now, if you're retired or you're getting close to it, I want to talk to you about something specific because the stakes are different for you now. This is called sequence of returns risk. Now, during your working years, the order of the returns that you got in the market, they didn't matter. A bad year followed by a good year averages out. You can keep contributing. Everything works out over time. But in retirement, sequence matters enormously. If you're in the first 5 to 10 years of retirement, the timing of returns can determine whether your plan works or fails. A crash in year 2, when you're withdrawing from that portfolio, it's potentially devastating. A crash in year 15 of retirement, and you're still withdrawing, that can be more manageable. Here's why. If you're depleting your portfolio while it's recovering, selling shares because they're down, it locks in the losses permanently. Those shares, they don't get to participate in that subsequent recovery. The portfolio that got you to retirement needs to be different than the portfolio that gets you through retirement. This is the reason for the cash buffer strategy. This is why moving to a more balanced portfolio, 30 to 60% stocks versus 70, 80, or even 100, actually increases your odds of success. And it's why flexibility in spending is so valuable. Now, all of this, it doesn't mean you need to panic. It means you need to plan. And if you have 2 to 3 years in cash, a balanced allocation appropriate for your current phase of life, and a flexible spending plan, you're going to be so far ahead of where most people are. And here's what I want you to take away. Market crashes are not a malfunction of the system. They're just part of how the system works. That same market that delivers long-term wealth for people, it also delivers periodic, painful, but temporary declines. You can't have one without the other. The investors who build lasting wealth aren't the ones who avoid the crashes. Unfortunately, nobody can do that. They're the ones who prepare for them. Expect them. Stay invested through them. If you're approaching retirement, or if you're already in retirement, remember this. The aggressive strategy that built all your wealth, it may need to evolve into a more balanced approach that protects it, makes it last. Build your cash cushion. Right-size your stock allocation for the new phase of life, and know your numbers. Make your plan. When the next crash comes, because it will, you'll be ready. And if you want to know if your current plan's built to handle what we just talked about, that's exactly the conversation we have at Glow Financial Planning. If you found this video helpful, please consider subscribing to my channel so you don't miss the next one. I'm Jordan Drinkhouse. I'll see you next time.